All right, hello everybody. This is Tom Randolph from GoldenCare. I want to welcome you to our webinar today. This is our special end of the year industry updates. We're obviously jumping into the new year, but hopefully we can help you hit the ground running here at GoldenCare and our friends at AIM. And one of the ways we do that is try to bring you the very best special guest speakers we have out there in the industry. And we're really excited today to have my friend Steve Moses on. Steve, as you probably know and you can see on the screen, is the head of the Center for Long-Term Care Reform. And he has his LTC bullets that a lot of us on the call here today know very well as well. And basically, Steve's one of those guys out there that I've had the pleasure of knowing in my 22 plus years of working here at GoldenCare. He's one of those guys that's committed his life to helping folks, and in the senior market especially, and he's done such a great job of being an advocate for us on Capitol Hill, and really just an ongoing mission to do his best to try to get some of these changes in Medicare and Medicaid, et cetera, so that we can help more people with long-term care insurance and peripheral products that we all like to sell and help people with. So that being said, he's a man, luckily for me, who needs little or no introduction. And it's my pleasure again to turn it over to you, Steve, and just let us know if you need anything from our side. Otherwise, we'll do like the rest of us, sit back and relax and enjoy your presentation. Thanks, Steve.
Well, thanks so much, Tom. It's a very warm introduction, very much appreciated. I want to thank everyone for tuning in today. It's really special for me to get in front of a group of some of my favorite people who are sharing this grand mission we have of improving long-term care for everyone. You won't see a PowerPoint presentation. I don't like to do them. I'm just arrogant enough to think I can capture your attention, and I want you to be focused on what I'm saying. I put a lot of work into preparing these remarks, so I hope you get value out of them as well. Now, I've decided to title today's presentation The Long-Term Care Trifecta. And the reason for that will become evident as we proceed. So, without further ado, you don't need me to tell you that the long-term care insurance business has faced some pretty strong headwinds lately. So I'm not going to dwell on that. Let's forget about bad publicity over premium increases, carriers leaving the market, consumer indifference to planning, damaging public policy, and so on. Set all that aside and think positively with me today. Let's try to understand what happened, why it happened, and what's most likely to happen in the future. Believe me, the view from the windshield is much more encouraging than the one through the rearview mirror. My goal today is to tell you some things that when you think about them and apply them to selling long-term care insurance, you will be more successful, help more people, and feel great about yourselves. In fact, it will be much easier than you ever thought possible. Sound good? Okay. When you face a challenge in life, and selling long-term care insurance, I think, certainly qualifies, the best way to begin is to review and understand what you're up against. Let me tell you a little story. In 1968, yeah, half a century ago, hardly seems possible, my late wife and I joined the Peace Corps. We were assigned to a tiny town in the Venezuelan grasslands called Carmen de Cura, 3 hours south of Caracas by bus. Our site sat behind a river with no bridge that flooded in the rainy season. We had electricity 4 hours at night if the generator was working. The house they gave us flooded from rain runoff, but also from the septic tank because of the high water table. How charming was that? Still, we loved the people and enjoyed the work. Part of our job was to meet with visiting doctors and nurses and back them up by supporting good health care practices when they left town and we remained. Unfortunately, they rarely showed up, never when scheduled, and they did very little to promote good health habits. Now, the Venezuelan Constitution promises health care to all citizens, but the government didn't deliver. That was a bitter early lesson that political entitlements guarantee nothing. Nowadays, everyone knows what a tragedy Venezuela has become by pursuing public policies that promise everything but deliver nothing. What concerns me is that we seem to be following a similar path here at home. We promise American citizens retirement income security, senior health care, and even long-term care. But Social Security, Medicare, and Medicaid come with no guarantees. A future Congress and President can and may have to cut those programs radically or even eliminate them entirely. And they can do it with the stroke of a pen. Where did we get the idea that government programs can take care of us? What has confidence in that idea done to our sense of personal responsibility? I think answering those questions will explain why long-term care insurance faces the challenges it does today. In the 19th century, as the United States was evolving from an economic backwater to an industrial superpower, people had to fend for themselves. There was no public safety net of any kind, only private charity. Free market capitalism prevailed. Waves of creative destruction disrupted markets. Competition compelled improvement. Sink or swim was the order of the day. That environment got the most out of everyone. People had a positive incentive to achieve and prosper, backed up by a negative incentive to avoid the poorhouse. Rough and tumble? Of course. Most people prospered, but some didn't, either by dint of bad luck or through their own irresponsibility. Life punished the irresponsible, and it provided strong lessons on how to turn their lives around. But good, hardworking people were also vulnerable to ill fortune. Private insurance evolved as a way to protect responsible individuals and families from the bad luck of unforeseeable events. Insurance allowed them to replace the small risk of catastrophic financial loss with the certainty of an affordable premium. Now, in the absence of government programs to lean on, responsible individuals worked hard to succeed, and they bought insurance to mitigate unpredictable risk. Such a system works well if you believe most people are good, capable, self-interested, and hence motivated. That's what our country's founders believed, and that's what they counted on when they gave us a government based on protecting life, liberty, and property, also known as the pursuit of happiness. So Americans did great for many decades after our founding, but no system is perfect. The more prosperity we achieved, the harder it became to accept misfortune or poverty of any kind in any amount for anyone. The Great Depression shook our country to its foundations. Arguably, government interference in previously freer markets caused that economic catastrophe, but whatever the cause, people were having a very hard time. The government wanted to help. Franklin Delano Roosevelt and his administration pushed hard for the idea of, quote, social insurance, unquote, as the solution. They said social insurance would improve on private insurance because it would have the widest possible risk pool, inasmuch as everyone would be required to participate. Social insurance would also be better than private insurance, they argued, because it would treat everyone the same, giving equal benefits to everyone. Therein lie the two fatal flaws of social insurance. It is compulsory and therefore violates the fundamental principle of freedom on which our nation's earlier success depended, and it spreads but does not price risk, thus rewarding irresponsible behavior at the expense of more responsible people. Let me explain what I mean. Ted Marmor is a Yale professor emeritus of some influence. He recently explained the difference between social and private insurance this way. Quote, in commercial insurance, he said, price must reflect risk. Social insurance, by contrast, operates on the premise that contributions are calculated according to one's income and benefits are related to one's needs, unquote. Now, does that idea ring a bell? Have you ever heard the motto, from each according to his ability to each according to his need? Yes, that's the Marxist creed, the fundamental principle of communism. That's exactly where Venezuela, not to mention the Soviet Union, went astray. This is a fundamental difference between social insurance and private insurance. Both spread risk, but only private insurance prices risk. Social insurance pays benefits to everyone the same, regardless of the level of risk they bring into the risk pool. Consequently, social insurance rewards risky behavior. You can be lazy, smoke, drink, take drugs, no matter. Social insurance pays everyone the same. But private insurance spreads risk as well, but it also prices risk. Your premium is based on underwriting, which measures the amount of risk you bring into the risk pool and charges you accordingly. That's why smokers pay more for life insurance, and it's why people already demented or dependent on walkers can't purchase long-term care insurance at any price. Pricing risk is fair to everyone. It is justice. It rewards good health care behavior and early planning, punishes poor behavior or failure to plan, and hence promotes social good. This is a critical point. Keep it in mind. Its other main difference from social insurance is that private insurance is voluntary. You're free to participate or pass. But social insurance is mandatory. It violates deeply held American values of freedom and personal responsibility. Okay, now, what does all this have to do with long-term care insurance? Since 1935, the government has told Americans, work hard, contribute to Social Security, and it will take care of you financially in your old age. Since 1965, the government has told Americans, pay your Medicare premiums, and you won't need to worry about health care in your senior years. Since 1965, the government has told Americans, whether or not you work or pay taxes, Medicaid will cover your long-term care if you ever need it and can't afford it. Americans believed those promises, and look what it got them. All three of the major programs Americans were invited to rely on are now on a slippery slope to insolvency. Social Security and Medicare are already consuming the IOUs in their so-called trust funds, funds that the rest of government borrowed, spent, and is having to pay back with interest, crippling our economy. Even those borrowed funds run out in the 2030s, only a little more than a decade away. Medicaid doesn't even have a phony trust fund to pretend to spend. It's a direct drain on general funds and hence on private investment capital. Do you get angry complaints because private long-term care insurance premiums have increased? Don't take it lying down. Stand tall, long-term care insurance carriers raised premiums to ensure that contractual benefit promises would be met. The government has done nothing similar to ensure it will be able to pay for promised benefits that it cannot possibly provide. Never forget that you occupy the moral high ground on the issue of premium increases. Claim it. So social insurance has done tremendous damage by making promises it can't keep, but that's not the worst of its impact, not by a long shot. The greatest negative impact of Social Security, Medicare, and Medicaid is the effect those programs have had on Americans' work ethic, saving behavior, and attitude towards private insurance protection. Nowadays, fewer people work, more rely on disability or welfare. Lifespans are shortening, waistlines are widening. We have an epidemic of obesity. Private companies no longer offer retiree health benefits. Why duplicate Medicare, they figure? Who needs long-term care insurance when the government pays for most expensive extended care costs anyway? Do you see the fix we're in? We've inhaled the social insurance drug for so long that we've lost the drive and incentive to take care of ourselves. This is happening when reality is about to force us to go cold turkey on that drug by curtailing, if not eliminating entirely, the safety net on which we've come to rely. Americans think the government should take care of everyone, and they don't care how much it costs. Here are a couple quotes from the Wall Street Journal. A Pew study found majorities endorsing the view that government does too little to help who? Young people, the elderly, the middle class, and the poor. Too little to help. Most of the federal government's budget goes to help those exact groups. Nor do we care how much it costs. Surveys also register a steep decline in public concern about the federal budget deficit. In 2013, 72% of Americans regarded deficit reduction as a top priority. By the beginning of this year, the figure had fallen to 48%. We are so concerned about the poor that we think deficits and debt no longer matter. But here's the irony with that view. Most of the poor aren't. According to a study published by the Cato Institute, quote, improved estimates of poverty show that only about 2% of today's population lives in poverty, well below the 11% to 15% that has been reported during the past 5 decades, unquote. Well, how can that be? Government poverty statistics make the poor look poorer and the rich look richer by ignoring most forms of public benefits paid to the poor and by ignoring taxes paid by the rich. Here's the net impact. It's a wash for the middle class. On average, middle-class households with around $63,000 in earned income get to keep it all. Yeah, they pay taxes averaging approximately $17,000 per year, but on average, they also get an equal amount back in government transfers. But the affluent have to make up the difference. Here I'm quoting. The top 47.5% of households were taxed to do the following. They have to transfer enough money to the bottom 52.5% of households to give them average spendable incomes close to the median income. They have to pay for the many activities of government that require 40% of all government spending, and they pay the interest on the national debt, which constitutes 12% of government expenditures. The Cato Institute concluded, quote, More than 50 years after the United States declared war on poverty, poverty is almost entirely gone, unquote. I conclude government should declare success in the war on poverty and start eliminating policies that discourage personal responsibility and work. Besides, what is poverty in America anyway? According to the Heritage Foundation, quote, the typical poor household, as defined by the government, has a car and air conditioning, 2-color televisions, cable or satellite TV, a DVD player, and a VCR. By its own report, the typical poor family was not hungry, was able to obtain medical care when needed. The typical average poor American has more living space in his home than the average non-poor European has, unquote. The anomalies and contradictions in government entitlements are unending. Conventional wisdom states that only poor people get Medicaid, but research shows that, quote, at the top of the income distribution, Medicaid covers 21% of lifetime costs at age 70, with the fraction rising to nearly 30% at age 100. While most high-income households do not receive Medicaid, those that do, and I interject here the ones that need long-term care, tend to have high medical expenses and tend to receive large Medicaid benefits. Hence, I've said Medicaid benefits the wealthy as much as the poor, if not more. What impact on demand for long-term care insurance do you think Medicaid's offsetting about a quarter of rich people's high medical expenses has had? Of course, tremendous. Government tells the poor explicitly, quote, don't worry about long-term care, we'll pay, unquote. The government tells the rich exactly the same thing implicitly by actually paying for most expensive long-term care if and when the wealthy need it. Nor does the government honestly report Medicaid's impact on the long-term care financing market. The Centers for Medicare and Medicaid Services, CMS, reports that Medicaid is the, quote, primary payer, unquote, for 62% of nursing facilities residents. Now, don't you think that would mean Medicaid pays most of the cost of the care for such residents? You'd be wrong. If a nursing facility resident is on Medicaid, Medicaid is counted as the primary payer, even if it pays nothing toward the resident's cost of care. How can that be? Well, people on Medicaid have to contribute most of their income, principally their Social Security income, but also private pensions and other sources, to offset Medicaid's cost. In some cases, the private income suffices to pay the entire cost of their care at the low Medicaid rate. Now, this is the critical point. Even if Medicaid pays nothing and the entire cost of the care comes from the Medicaid recipient's private income contribution, the nursing home receives the low rate of Medicaid reimbursement, often less than the cost of providing the care. That's why Medicaid has such a poor reputation for quality of care. Now, why on earth would Medicaid operate this way? Claiming that Medicaid is the primary payer for nearly 2/3 of nursing home residents gives the appearance that Medicaid does more for more people than it really does. It makes public officials, senior advocates, and politicians look good. It wins votes. There's still more to this deception, however. CMS reports out-of-pocket costs for nursing facility residents to be over 25%. But the reality is that half of all out-of-pocket costs are really just spent through a private income by people already on Medicaid. That makes it look like Medicaid costs less than it really does. Bottom line, Medicaid takes credit it doesn't deserve and then misrepresents its cost to the downside. In the meantime, the damage to consumers is incalculable. Over 80 years of believing in government promises that social insurance entitlements will take care of us have desensitized consumers to all kinds of insurable risks. But that's all about to change. I call what lies immediately ahead the long-term care trifecta. A trifecta is a bet in which the person betting forecasts the first three finishers in a race in the correct order. So here they are. The first finisher is Medicare. Its trust fund runs out, not that there's anything in it anyway, by 2026, only 7 years away, 3 years sooner than previously projected. The second finisher is the baby boom generation. It starts turning 85, the age at which health and long-term care costs spike upwards in 2031, only 12 years from now. The third finisher is Social Security. Its literally empty trust fund runs out in 2034. Unfortunately, we may not make it to the first finisher in 2026. As I prepared these remarks, and by the way, as I watched the stock market today, the bottom was falling out of the stock market and a recession in 2019 was looking more and more likely. Since the Great Recession of 2007 to 2009, we've been living in an economic fantasy land with artificially low interest rates and profligate government spending enabling us to live far beyond our means on funds we've borrowed from ourselves and from foreign countries. When the asset bubble created by those policies bursts, all bets are off. Markets are predictive, so collapsing equity and real estate values combined with higher interest rates on private and public debt could plunge our public finances and the entitlement programs they mostly support into crisis much earlier. We may face the long-term care trifecta at any time. So what does this mean for you and for long-term care insurance? Long-term care risk and cost are greater than ever. Oncoming demographic challenges, the so-called age wave, is cresting, and it will crash soon. The need for private long-term care insurance protection is greater than ever. Consumers need to plan for this risk. Yet, although consumers are smarter about long-term care risk and costs than they used to be, thanks to our decades of work waking them up, right? Most still don't operationalize their knowledge enough to take concrete action by insuring for the risk. That's where you come in. You are the last line of defense against the idea that people can ignore the risk, avoid the premiums, and wait for the government to take care of them. That headwind holding back private long-term care insurance is disappearing as the LTCi trifecta nears and arrives. You should redouble your efforts in the knowledge that you can save people from the awful fate of relying on public programs as those programs are collapsing. Do you read Ron Hagelman's column in Broker World? If not, I think you should. He argues that in the past we pushed too hard to get full long-term care insurance coverage for every client, resulting in too few people being able to afford the protection. Going forward, he suggests, the challenge is to help people mobilize all of their financial resources, supplemented by long-term care insurance, with the primary goal to stay off Medicaid. That's good advice, makes protection affordable for more people, and ensures that fewer will be stuck in welfare nursing homes as their major funding source, Medicaid, dries up. One of the biggest problems for long-term care insurance lately has been the necessity of companies to raise premiums on in-place business. But actuaries' concerns about future premium increases are abating. New policies' premiums are based on longer and better experience, and the huge damage done by governments forcing interest rates artificially to near zero is reduced as interest rates normalize again. You should muster and deploy the verifiable evidence of this development in your meetings with prospects and clients. Did premium increases and the widely publicized Penn Treaty insolvency hurt traditional insurance? Of course, but asset-based products evolved to provide guaranteed premiums and benefits. Both kinds of products have critical roles to play in the market, but one or the other may prevail temporarily as the headwinds, largely caused by poor government policy, shift in direction and intensity. If I'm right about the plummeting direction public programs are likely to take, all forms of private insurance, including traditional LTCi, hybrids, products modeled on a health insurance chassis, term life that converts to long-term care protection as proposed by the Society of Actuaries, and designs yet uncontemplated, will thrive in the new, challenging economic world. I'm tremendously encouraged by the amazing creativity and resilience of the long-term care insurance industry, including the carriers who are sticking it out, the exceptional distributors like GoldenCare and AIM, and you, the producers, the AMGs, altruistic, masochistic geniuses who manage to carry on in spite of these challenges. So many of you are driven by a passion for this work because of a personal experience of long-term care with a loved one, parent, a grandparent, a spouse. You've proved over and over again that nothing can stop you. Many carriers were less persistent. They abandoned the long-term care insurance market when utilization increased beyond actuarial expectations. The Federal Reserve destroyed returns on their reserves, and the media attacked the industry for doing the right thing, that is, increasing premiums to ensure benefits would be paid. Here's what I predict. Those same companies, and new ones, will come rushing back into the business as those problems disappear. We now have better and longer experience data on which to base premiums, and they've already increased for new products. So as interest rates and hence returns on reserves return to normal levels, the business will become highly profitable, leveraged by the fact that premiums have already increased. As the pressure I've predicted on public programs hits over the next decade, the public will lose confidence in Medicaid, which is propped up by Social Security and Medicare, in which they'll also lose confidence. When that happens, Katie, bar the door. The rush to find insurance protection against long-term care risk and cost will explode. Consumers will prospect for you. In the meantime, we're all in this together. I want to thank you for your dedication, hard work, collegiality, and friendship in our common mission to improve long-term care for all Americans. Before I conclude, I'd like to tell you a little bit about how we pursue that mission at the Center for Long-Term Care Reform. We conduct state-level and national studies of long-term care financing with a focus on the problems created by government interference in that market. You can find and read dozens of our reports at our website, LTCi.com, and on the handout you've been given for today's presentation. We publish periodic essays called the LTC Bullets. The bullets discuss and analyze current topics related to long-term care service delivery and financing. We've done over 1,240 of them in the center's 21 years, and you can find them archived chronologically and by topic on our website. We publish a weekly compendium of long-term care news called the LTC e-alerts, designed to keep members abreast of everything they need to know to remain on the forefront of professional knowledge and expertise. Our daily LTC clippings give premium members access in real time to the latest stories, articles, reports, and data as these are released, along with our take on what they mean in a sentence or two. Our members-only website, also known as The Zone, is full of invaluable resource material, including our voluminous Almanac of Long-Term Care, where we've archived all important news about long-term care and organized it within 11 subtopics. Finally, I want to thank GoldenCare and its staff and management for this opportunity to share some ideas with you today, and for their long and invaluable support for our work at the Center for Long-Term Care Reform. I'll conclude, and glad to attempt to take your questions now.
Thank you very much, Steve. This is Tom Randall again from GoldenCare. And I'll address the questions in a second, but I do want to just take a moment to obviously heartfelt thanks to Steve for a very insightful and well-researched presentation as always. Thank you again for that, Steve. And for you agents out there, I really want to reinforce what Steve said. You really are the last line of defense out there. I'm a firm believer in a lot of what Steve says, and I'll tell you what, if you don't buy the fact that most people aren't buying long-term care insurance because it's not the premiums. They're worried about what the premiums will be. So one of the things we want to make sure is we let you know that GoldenCare, if you can maybe get that ending slide if it's possible, GoldenCare has the resources for you, and our friends at AIM have the same resources to really help you out when you're in the trenches. We have all the peripheral products out there. We know that long-term care has become much smarter, and the industry is much smarter in the old days, so we don't just take anybody who can breathe on a mirror. We have peripheral products to help you out for people who don't have the health to get long-term care insurance. And more importantly, we have some tools to help you show the need, like Steve talked about. And one of the great ones that just comes to mind is the Brokers World article. I think it was March of 2017. Mark Lichtman did a good job co-authoring that. Talked about the fact that, you know what, we have 70 times more claims data out there. We understand the lapse ratios aren't what they thought it was initially in the early industry. We know people don't drop the policies. And we understand the return on investment like Steve talked about, and we don't sell unlimited plans and 5% mandatory inflation, et cetera. So we have the ability out there. The SOI came out in the article. It mentions 2014. There's a 10% chance that the policies of today with the gender pricing, et cetera, will have a rate increase that's significant. They guess 10%. The last SOI meeting that they went to said this year was 5% chance. So these policies today, they may have a rate increase in the future, but it's not going to be those catastrophic rate increases that hurt the industry so much on that legacy block of business out there. So I'll get off my soapbox on that, but I do want to let you know we have tools that will help you, help convince people out there that long-term care is much more stable than they may assume. So that being said, the question part is going to be a little bit tough, Steve. I'm going to tell you right off, we're in presentation mode, as you can tell. We do have a lot of folks who typed in some things, and if you can read those, do you think we can read those? Or
yeah, if I walk.
We're in a presentation room, Steve, so I don't even know if I can read them from here. Why don't we do this? You know what, everybody? I really apologize. With this big a group, if we open it up, I've done this for too long, it's literally chaos. We'll hear so much background noise, it'll make your head spin. But with Steve's permission, I do know his email address. If you don't mind, Steve, can I get some of these questions and gather them together? And you folks can email me at TomR, if you have a pen there, tomr@goldencareusa.com, tomr@goldencareusa.com, and email me the questions, and we'll answer some that we can. And if you have directly for Steve, I'm sure I can get those. His email is actually on the screen there as well. Sorry, Steve. I hope you don't get packed with tons of emails.
No problem. I love emails. Keep them coming.
See in the bottom right, smoses@centerltc.com. Otherwise, I know some of you typed in, and we have those on record, and we'll address those in that same way probably, because we have a lot of them. Some of them are pretty long questions. Steve, I'm going to let you off the hook for today, but I promise I'll probably hunt you down with some of these questions in the near future, if that's okay.
Fair enough.
Okay, and thank you everybody again. Steve, if you have any closing comments, I can't stress enough our whole team here. You know, we love you to death, and we appreciate all you've done for the industry. Thank you so much for today as well. You did a great job as always. Thanks, Steve.
Well, thank you. We're not going to do any questions now. I was looking for emails to come in.
Oh, do you think do we want to do that? There's just 3 of them. Okay. You know what? Maybe we're going to read off a question if you want, Steve.
Yeah, read out one. Just read 1 or 2 to me, and then send the rest by email, and we'll get this done after all.
Okay, thanks, Steve.
One of the questions that go where it's talking about it, Medicare Advantage plans are now offering a 1-year short-term home health care benefit as kind of part of their menu. And they're continually adding more benefits. What impact do you think that's going to have on long-term care?
Virtually none in terms of any substantive effect, because you get what you pay for, and you're not going to be paying much for, and you're not going to be getting much. The problem with this is the message it sends to the public. One more message after Medicare and Medicaid. Don't worry about long-term care because we'll cover it through your Medicare Advantage plan. It's not going to happen, and unfortunately, like so many other things the government does, the damage is out of all proportion with any benefit that accrues.
I tend to agree with that, yeah. Actually, there's another one here, Steve. So with filial laws, do you see filial laws being enforced more as we start to run out of money?
No, I really don't. I've followed this for better part of 40 years. When I was still with the U.S. government working for Medicaid, we tried to implement that. It was on the books in Idaho, which was my state at the time, and we tried to enforce it, and it just was politically infeasible. So my view on it, having been through that experience, is that filial laws really aren't necessary. You don't need to go to the children if you just stop enabling them to get big inheritances by putting their parents on welfare. That's where you need to go. Catch it before the problem develops by improving the Medicaid income and asset rules so that they don't encourage dependency on Medicaid. And, of course, so much of what I've done over these last 30, 40 years explains why that's necessary, how to fix it. We haven't gotten it fixed yet, although we've had some major federal statutory successes many years ago, and then more recently in 2005. But we still have a long ways to go. The problem is in economic times like we're in now, where nobody cares how much the government spends, we seem to be just pushing this into the future. We're creating a huge asset bubble, and when it pops, what I just talked to you about will occur, and we are going to pay the piper when we have the hangover for this party.
Okay. There's another one here regarding partnership and the fact that Illinois is now coming on board with partnership. They want to know, will partnership be applied to those policies who bought the right inflation protection, structured it correctly when they do come on board? I can take a stab at this, Steve. I know that with Mutual Omaha, when Alabama came on board for partnership, they decided not to go back and make those policies partnerships. So it's kind of a carrier decision, I think, state by state. But as Illinois comes on board, it'll be kind of the carrier if they want to go and send out the letters, remember those big letters that would make them exchange letters or whatever. So can you speak to that at all?
Well, it's a little bit too inside baseball for me, and I think you probably said the right answer. I would say this. Illinois is an economic basket case, and I can't imagine they're doing much of anything very efficiently. I've spoken well of partnership programs over the years, but I also wrote a chapter in a book once explaining why they failed and how to fix them. And the problem with partnerships is that they try to get people to buy insurance by promising them a spend-down exclusion later on when there is no real spend-down in the first place. So we have to fix the eligibility, and then partnership will work, although if we fix the Medicaid eligibility, you don't even need the incentives in partnerships to get people to buy. So that in a nutshell is my view on that. And that chapter that I wrote that goes into detail is available on our website if anybody wants to dig deeper. In the meantime, hey, partnerships give long-term care insurance a slight boost, and I'm all for them. I just don't think they're as effective as they would be if it weren't for the crazy Medicaid eligibility rules we have.
Okay, yeah, thanks, Steve. Like I mentioned, too, we've seen in the past where some carriers will deal with some won't, it's behind carrier. Just two more quick ones is all, we get you out of here. Do you ever feel there'll be another class act introduction of any kind, including a push group LTC or employer-based?
No, I think these goofballs learned their lesson with the Class Act. That occupied me for about a year and a half, explaining why it was infeasible. And, we successfully stopped it. The problem now is a little bit different. We have advocates for expanded government financing, even working with some people within the long-term care insurance industry to promote the idea of mandatory government catastrophic long-term care insurance that then private industry could wrap itself around, kind of like the way it does with Medicare. And for reasons I elaborated in some detail in my remarks, I think that would be a tragic mistake. Doing anything along those lines is very much like adding deck chairs to the Titanic after the little incident with the iceberg. I mean, it just doesn't make any sense. We've already broken the camel's back. The camel just doesn't know it yet, and when it figures it out, we're going to see most of these entitlement programs go by the wayside.
Okay, last one, Steve. We'll kind of let you wrap it up here. Again, if you're going to type in more at this point, we'll just hold it later. Do you see financial planners being sued for not offering LTCi to their clients? We do see this question a lot. Steve, I'll let you speak to that.
Well, yeah, I've been hearing that for the better part of the 30 years I've been involved, and I haven't seen it happen yet, and I seriously doubt that it will, not that it shouldn't. So you all sharpen your pencils and write your lawsuits and find an attorney willing to help you, and let's see if we can get it done.
We do have, just as a tool, like Tom mentioned, we have a decide not to purchase long-term care disclosure form that kind of protects you from that. If you want to tell a client you offered long-term care, they decide not to, you can just sign a form saying, I offered long-term care to them at this date. They decide not to take it, put it in your file, protect yourself. We've got something like that.
Yeah, I think that is an excellent idea. Now, whether you could ever enforce it in a court of law, I don't know, but I think it sends an important message to the client.
That's more or less what it is, Steve. It's more or less a takeaway where you're going, well, what am I doing here? So that's what we do it for. All right, I think that's all of them. Tom, anyone else?
Yep, I want to thank Jeff Clark. I'm getting old. I had my cheaters on. I couldn't read the screen, so thanks, Jeff. And Steve, again, thank you very much. And everybody else, I know you have a lot of questions, and Steve's a great guy to go to. So, again, his email is up there, so I can't stop him now, Steve. smoses@centerltc.com. And if you want to email me, it's tomr@goldencareusa.com, and I'll do our best to have our team here help you out as well. So the big thing, I wouldn't be doing my job if I, number one, didn't say thanks again to Steve, and number two, told you that it all does start with you as a last line of defense. You better make sure you're appointed, set up so we can hit 2019 running, and we have the tools to help you get you there and the products to help get you there as well. So please make sure you take that important first step if you're not already appointed with GoldenCare AIM. Steve, unless you have any closing comments, thanks again, and appreciate everybody jumping on today as well.
My pleasure.
All right.
Bye for now.